Good evening, everybody. Ron Wheeler here, manager of options trading, and it's my pleasure to bring you tonight's special presentation, how to turn market chaos into monthly paychecks. Well, if you're watching the market right now, or you're even watching the news, what are you seeing? You're seeing this chaos, right? The headlines are screaming, there's fear out there. We still have inflation worries. Is this going to start ratcheting up again with the tariffs? Is the Fed going to cut rates? Stocks are moving back and forth. This is a time, unfortunately, when a lot of investors panic or they freeze. They make bad moves. Well, first off, let's define what chaos or these big stock swings or the high volatility times look like. So here's what I do. Keep it very simple. This is market timing. The market timing graph here in VectorVest. And one of the things that I like to do to gauge how volatile the market is, I look at a simple indicator, the average true range. If the average true range is high, that means volatility is moving a lot, and the market is therefore moving a lot. So what is average true range? Average true range in this case is the last 14 days average market move. So you can see that really over the last year, there's been times when the ATR has gone high in like August and into September of last year, but overall, on the market timing graph, it stayed to probably an average around 75 cents to 80. 75 to 80 cents on average. But then you can see in March, it really started picking up. We had a little bit of a reprieve in April, and then the tariffs were announced, and you can see that the volatility has picked up tremendously, and the average move of the market timing graph has been $2. Now, another really easy way to see where the volatility is take a look at the VIX. The VIX is the volatility index of the S&P 500. Now, normally, I would consider high volatility anything over 25. So 25, it's about right here on the graph. So right in this area right here is where you're going to see that 25. And just to make it a little bit easier, let me just draw a line right there. So 25 is about right here. Now you can see again, there are periods of high volatility. We had some periods back in late, looks like July, and then we had a period here in December. We had a little bit of a spike in March, but really anything right here past the tariff announcement really drove the VIX crazy. It hasn't been that high in a long time. $50, $45, $40. It's fortunately coming down right now, but I want to show you how volatility can actually help you. Most people run from the volatility, but we use it to create income by increasing probability in our trades and decreasing monetary risk. Now here's how we do it. First and foremost, as the options guy here, I'm an options trader. I'm an options seller to be more specific. When volatility gets this high, that means stocks and the market move even more and more, correct? Of course. But when we sell options in volatile market, that lets you actually collect bigger premiums. Or if you don't want to collect the bigger premiums necessarily, it allows you to place your trades farther from the stock price to increase your margin of safety. Now that's the beauty of this. A lot of people don't know this about options, but options and option premium are really one of the big components of that is volatility. When volatility goes really, really high, the premium on the options goes up and the probability at which you can sell options starts to expand as well. And I've got a great example of this for you tonight so you can see how this works. And again, I want you to think of it like building a stronger wall of protection around your money. More volatility, more movement, and better risk. So let's talk a little bit about probability and how it's explained here. So again, more volatility equals more movement expected. That's normal, right? You saw it on the market timing graph, and then you also saw it on the VIX. That means the safe zone for your trade really needs to be wider, and the increased volatility helps you do that, which is even better. Now, the best part of being an option seller is you don't need to be right. You just can't be terribly wrong. So let's explain how this works. And I've got some great examples for you tonight of how the increased volatility can decrease your risk and give you more room to be wrong. Now in this example, I'm going to use Google. I like to use Google for this because I know there's a lot of options liquidity. Plus, I can pick two really good points in this that show you the difference in how this works. So first off, I'm going to pick two dates on Google. I'm going to choose April 15th, which is just a few days ago. It was right here. So I'm going to mark April 15th right there. And then I'm also going to choose back around September 3rd. So September 3rd last year was right, keep going back here, right about here. So September 3rd. Now, why did I choose those two dates? I chose those two dates for a couple of reasons. Number one, because the stock was basically around the same price. It was right around 160 bucks, give or take. The second reason I chose those two dates is because if you look down here, you can see that my average true range was very low, meaning the stock was only moving about $3.60 a day, versus over here, you can see the stock is moving at about $7 a day. So it's pretty much twice the expected movement. So right here, volatility is increased. So there's two ways, especially in the options market, we can measure volatility. There's historic volatility, and let me show you what that looks like. So we talked about how to quantify it with average true range, but let's quantify it with something else that's more in lines with how we trade options. And the first thing I look at is the historical volatility. And all historical volatility is it's in the way that we use it. And this information can be gotten really from any broker out there. I'm using Options Pro in this case, but historical volatility, I'm looking at the last 45 trading days. 45 trading days, and then what it's done is it is annualized. So in Options Pro, I'm going to show you what historical volatility looks like on these 2 days. Back on September 3rd, my historical volatility, and if you look up in the upper left-hand corner, you can see it's 27.85%. Now, people would say, is that high? Is that low? Well, you really can't know from just looking at the number. You'd have to really look at a graph of what that volatility looks like over time. And I would say just by looking at this graph right now and looking at the volatility, I would say it's probably right in the middle. It's not really high, it's not really low, it's kind of right in the middle for volatility on Google. Now, let's go over and take a look at 415. You can see that in the upper left-hand corner in that crosshair window, my volatility is set to 39%. So you can see there's already a difference of almost 12% in that volatility. The stock is moving a lot more. And again, is 39% a lot? I don't know. 39% in a vacuum might be a lot, it might be a little. You have to look at the historic movement of Google over time. And if you look, yes, it's pretty much right there near the highest point of volatility. Okay, so that is a very high number, whereas 27% is kind of right smack dab in the middle. But a 12% increase in volatility in this particular stock is a big, big deal. So next, how do we actually look at this? How do we profit from it? What do we do with this high volatility? And to explain this again, I'm going to go back to the slides. I'm going to do something that I've been doing here at VectorVest now for the past decade, and even longer than that in my own personal trading. When I see an opportunity to trade, I like to do an option spread, specifically credit spreads. And the reason why I like to do credit spreads is because you don't need to be right on these trades. Again, you just can't be terribly wrong. So what we're going to do is we're going to sell options far away from the action. We're going to get paid even if we're wrong with the trade. We're going to keep repeating the process over and over again, focusing on that probability, focusing on that risk, keeping our risk small, keeping our probabilities high. Now, again, the beauty of what we're going to do in these high volatility markets is when the volatility is higher, the premiums that we collect can go higher. And what that means for us is we can push our probability out even further and still carry the same risk. So let's talk about that. Let's put together a couple trades on Google to see how this works. Now, The next component of how volatility for options are priced is called implied volatility. Now, implied volatility is a little bit different than historic. Historic is what the stock has done in the past, whereas implied is what it may do in the future. So I'm going to go down to my volatility graph down here. I'm just going to right click and go to Edit Study, and I'm going to take that volatility, and now what I'm going to do is I'm going to take off the historic and I'm going to add implied. So what you can see here now is that back here, when the market was obviously a little bit more normal, if you will, that my implied volatility on the option was only about 24%. So my HV at that time was 27, my implied was 24. That typically in the options world means the premium is underpriced. It's very, very inexpensive. Typically not the best time to be an option seller. Now, if I go over to April 15th, you can see that the implied volatility is about 40%, whereas the historic volatility was, if you remember, 39%. So even in this 40%, it's only about 1% difference between the HV. So this option is what I would call slightly overpriced. And it was actually a little bit more expensive a few days ago, but again, I'm trying to use where the price is around the same, so that way we have a good equal comparison between the two trades. So let's do this. We're going to set up, and I'm going to open up my little spreadsheet here, my little text document I like to use. We're going to set up 2 bear call spreads on Google. Not Goof, Google. That's the funny part of this. You get to see me make all my typos. All right, spread number 1 was back on 9/3/2024. Spread number 2 is going to be on 4/15/2025. And if you remember, this was low ATR, low HV, low IV. Now on 4/15, you have high ATR, you have high, I would say higher historical volatility for sure, and then a high implied volatility as well. So let's take a look. What we're going to do is we're going to start by putting a trade together back on September 3rd. So what I want to do typically on September 3rd or even on 4/15 is I want to look for an option that has a probability somewhere in the under 40% range. So I'm going to go back into my option chain, and I'm going to go back on Google, and we're going to go back to September 3rd, 2024. And we're going to look at an option that expires on, we're going to use back then, I think we're going to use October 4th. And I'll explain why I'm going to use October 4th in a minute. All right, so here's the scenario. Here's the graph again. I'm going to move the chart back and just move the chart back to September 3rd. That's the day that we're placing this trade. Now you can already see the stock's going to go down after that, and that's fine. This is just for educational purposes, right? So on September 3rd, I think the stock is going to go down. What I want to do is I want to sell a call above the price of the stock. So on that date, I'm going to go back to my option chain. The stock that date closed at 158.61. So we're going to use the closing prices. Now what my goal is I want to sell a call that has less than a 40% chance of going in the money. So in the money simply means that in a call situation, the stock price has risen above the strike price. So if you look over here on the options, and I understand that if you're new to options and this isn't making sense to you, that you might not be ready for this level of options trading or income trading, and that's fine. We have other things we can do with options too. But what I'm saying here is this: the stock's at 158. If you have a call at 145, well, guess what? The stock price is above the call price. That's an in-the-money option. Now, if I look down here at 170, the stock price being 158 and the option price being 170, or the strike price, that means the option's out of the money. When I do these trades, I sell an out-of-the-money option, and I want it to stay out of the money. So looking at the in-the-money probabilities, if I go less than 40%, I've got a 165 option. The stock is trading at 158. I can sell a 165 call, and that gives me a 29% chance of going in the money. Now remember, in the money is the enemy. All right? So, looking at that graph, I can go up here and sell an option right above the current price at 165. Now, the problem with that is it leaves you unprotected. If the market makes a huge move up, you can be left with a catastrophic loss. So as I said, I'm doing a bear call spread. I'm going to sell a call that has less than 40% ITM. In this case, again, that was the 165. Then I'm going to go up even further, and I'm going to buy a protective option, a put, or I'm sorry, a call. In this case, a 170. So I'm going to sell a 165. I'm going to buy a 170. Now, quick and simple, I'm going to go back and I'm going to look at the option chain, and based off the prices of those two options, I'll just use the last price. You don't have to memorize these numbers. It's not that important. Just looking at the last numbers, I got $2.27 for the premium minus 110. I'm getting $1.17 in premium. So $1.17 or $117 for every contract that I sell. That's the most I can make in this option. Okay. Now, as far as risk on this trade, the risk of the trade is limited to the width of the spread. So $5 minus 117. That's going to equal $3.83. 383. I did that math in my head, so hopefully it's right. Okay, so that looks pretty good. It's got about a 29% chance of going against me. Okay, and on this trade, we have a $3.83 risk. Our profit target on the trade is $1.17, and that trade from a risk reward perspective is going to give me a risk reward of about 3.25 to 1. Now, for those of you that have never sold options before, that's actually pretty good. Remember, you have essentially I'm rounding here, a 70% chance of this trade working versus a 30% chance it doesn't. So that right there is a very typical low ATR trade on something like Google. Now, to save a little bit of time, I went ahead and already did this for you, but on the graph of Google, I used a replay tool in Options Pro called Options Replay, and if I click right there, you can see that I sold one October 4th, 165, I bought a 170, and I used the exact same options premium there. We collected $1.17. My goal for this trade is to make about, $60 on the trade. And you can see it again, that's $60 per contract. So I would typically do this at a $1,500 premium. I'd probably trade 12 or 13 contracts, and I'd want to make about $60 a contract. And you can kind of see over the next couple of days, right? We actually right there made our $60. We would be profitable in only about 3 days, and then the stock kind of reversed on us. We'd be out of the trade, and you can see that really right about here, this is where the stock would have gone back and went against you. So looking at this is where you would have exited the trade had you not hit profit. So in this particular trade, we did make our roughly $60. Okay, that's good. Let's say it didn't go down there and it just went straight up. If you take a look right about here, this is probably going to be your best estimate. Look at what that loss is down there. You're going to lose on the trade about $60. So the idea of this trade is this. When we sell something, we're going to collect our profits at 50%. So I sold it for around $1.20. I'm going to make about $60. Okay, and then I'm going to exit the trade if the stock goes back and hits 165 and those options go in the money. So with this trade, I would have had a $60 profit. If it would have not hit profits, I would have had a $60 loss. And that trade was at, again, right at 160 when the stock was 158. Okay, so you had about a $7 cushion. Now, let's go ahead and move this thing out. Let me go ahead and remove this from the graph. We'll go ahead and remove that study. And let's go and we'll move the graph over to April 15th. Well, I'm sorry, April 15th. everybody's favorite day, tax day. So let's put a trade together on April 15th. Let's go to our option chain. We're going to move this date back to April 15th. There it is. And I like showing this stuff, by the way, because this is the raw numbers. I can't make this up, essentially. It's the raw numbers of what we're doing. Now, first and foremost, I want you to go, we're going to go to the May 16th. And if you remember correctly, I used the October 4th option for the first example at 31 days to expiration. The reason I use that is because I could match it perfectly to the May 16th, which expires next month at 31 days to expiration. I wanted to give you an example where we had the same days to expiration. Okay, now take a look at Google. If you remember, we had about an ITM of 30%. If I take a look at that 165, that same option in May for right now, look at this thing. That ITM is 35%. I can go out to 170 and it's about 27%. Now remember, I did the 165 and had an ITM of 29. Now down here, I can do a 170 and I'm at 27%. So it's only a 2% difference, but because of the volatility, I'm getting a lot more room in the trade. Now here's the next best thing, okay? If I do this trade at 170, I want you to look at the premium here. If I look at just the prices of a 170, 175, you're at 289 minus 169. The premium on that trade is $1.20. You still have the same $5 risk. You now have $1.20 premium, and that means my risk on the trade is $3.80. So what's happening here is I'm getting not only 2% more statistical probability in this trade on April 15th, I'm also getting $5 more in room. Now, again, I want you to look at the raw numbers of this and think about this. If we go back and the stock's at like 158.60 and we're selling a 165 option, that gives us about a 4% difference in buffer. So if the stock moves 4%, you're going to get stopped out. Now we're at 170. Okay, if the stock is still at 158.60 and we're selling a 170 call, now we're increasing that to about 7% difference. Looking at the graph, you can kind of see 170 is taking you all the way up here. Okay, you're getting slightly better risk reward for that trade, and you're getting a lot more room to play. That's the beauty of this, okay? A lot more room to play. You're not just doing a 165 anymore. Now you're all the way out at 170. Now, if you wanted to, and this is kind of also the cool part, now, and this option may not be specific for this, but if you wanted to go even further out, we could do a 175, 180, 168 minus 98. Not quite enough premium, but in a lot of examples, we could even go further out. Okay, so looking at this trade, we're sitting there now, the stock's at 158. We've got about a $12 buffer to be wrong, which is good. Because if we go back to the average true range, right now the stock's moving at about a $7 clip. We have $12 to be wrong. Back here, the stock was moving at about a $3.60 clip. And guess what? We had a $6 or $7 distance to be wrong. So with the increased volatility, the option market is giving us more room to work with the same risk reward. That's the beauty of this. Now, through the beautiful use of editing, you see I've already added the options replay tool to that trade back on the 15th. I did a 170, 175. If you remember from the numbers, it was about $1.20. That means I'd want to make about 60 bucks. And you can see only a couple days later, it looks like on 4/21, I would have reached that $60 profit. Now, if you hadn't taken profits, which you should have, the market is starting to move against you. But look, you still have a lot of room to be wrong on this trade. And your profits have kind of dried up and you're back to break even at that point. So I want you to think about what this does. Okay, think about what this does. So Google again was $159 a share on both those dates, September 3rd and April 15th. Both of those spreads had $1.20 or $100 per contract maximum profit. The difference is on September 3rd, you had at a 165 call a 3.7% buffer to be wrong. On April 15th, selling the 170, and again, these are both the same dates to expiration, you had a 6.5% buffer to be wrong, risking the exact same amount. Now, if you say, well, Ron, that's not exactly apples to, apples comparison. Well, let's say that instead of doing a 170 call on April 15th, what if we did the same 165? Let's go back to the options chain because I want to show you the numbers. I want to show you that I'm not using made up numbers. The 165 option, the last price was $4.70. So again, we'll just use the last price. And then on the 170, we're at $2.89. Okay, so take a look at this trade. Now, I'm throwing something at you called a risk graph. And don't worry too much about, well, how do I read a risk graph? The risk graph in and of itself is not important. What I want you to do is I want you to take a look at the right-hand side of the screen. Look at this number right here, these numbers. This trade has a $181 max profit and only a $319 risk. So even if you said, well, Ron, why can't you compare the 165 to the 165? The answer is you can. The difference is you're getting a $1.80 premium versus a $1.60 premium. Or $1.20 premium, pardon me. You're getting 60 cents more premium for the exact same trade if you wanted to compare apples to apples. Now again, I'm more of a proponent of keeping the risk the same and getting more room to be wrong. Because remember, I want the safe zone to be wider. That way, I don't need to be right. You can't just be terribly wrong. So, kind of in a nutshell of what we talked about. These increased volatility markets, they provide more options premium. That more option premium can be leveraged to get you more probability. Or if you want to trade at the same levels of price, you're going to get a lot more premium to reduce your risk even more. Now, if this level of income trading is right for you, if you're an options trader, if you know what a call or a put is, and you're not looking at this with your head in the clouds and kind of understanding a little bit of what I'm talking about here, if this is something you're interested in, we can definitely help. And to get that help, we're launching our Options Paycheck course starting in May. So if you are interested in kind of putting this all together, learning how to navigate the markets, create income in any type of market condition, now is really the time for you to do that. It's an 8-module course. We teach the course live and via recording in May, and then we launch into our implementation month in June. So for the next 2 months, you're going to have an opportunity to work with me and our team to really help you implement this into your trading system. We've been doing this now for almost 10 years. We have a lot of satisfied clients, and it really is the primary way of generating good monthly income. So in addition to the 8-module course, we also include a mastery package bonus. You're going to get module by module mastery sessions. We want you to do 2 modules a week. We're going to meet together live to discuss those. We'll also have a weekly Q&A. You're going to get access to my private dedicated email for the Options Paycheck where you can bounce questions off me. You could ask me to go over things in class and I'll certainly do it. For those of you that don't have access to VectorVest and Options Pro, we'll give you 2 months access. You'll start May 6th, and you'll kind of have a subscription to VectorVest and Options Pro through the end of the course in June. We also give you in June that implementation month. You're going to see me trade this live with my coaching students. You're going to see me manage trades, place trades. In addition, we also have office hour sessions during the month of June. You're essentially going to get 4 times a week to meet with me where we're going to find, set up, select, and put these trades together. Now, another trade that I've been doing for a very long time is the SPX paycheck trade. It's averaged about 2.4% per month in gains over the past 8 years. We're going to teach you that as well. So if you want to start with just one trade a week, this is a great way that a lot of our students start. You can kind of use this as well in addition to finding stocks, but it's a nice little element of our full income system. So just as a quick reminder, with the whole options paycheck experience, you're going to get those 8 training modules. We teach those live starting in May, but if you can't view our live curriculum, we also have it recording. You can watch it that way as well. It comes with videos and checklists and cheat sheets, quizzes. We have videos for different brokers. The mastery package, which is the live presentations to really get together and discuss the core curriculum. Make sure you don't have any questions. The implementation month, where we're going to take the material that we learned in May, we're going to implement it in June to make sure you know how to place these trades, and our SPX paycheck system. If you register right now at optionspaycheck.com, we're giving you a discount off of our early bird $12.95 price. You're going to get it for $9.95. So again, get it going. Go to optionspaycheck.com, get yourself registered. We've had this class now here for almost 10 years at VectorVest. It's one of our more popular classes. We have a lot of successful students behind it. So also I want to mention, if you have taken the options paycheck before, there is a special alumni rate of $4.95. You can just call our office and we can get you signed up for that as well. Now this offer does end Monday at 6 p.m. So 6 p.m. Eastern. So make sure you get yourself signed up. And before I kind of close, I want to be totally upfront with you. You know, over the past decade, I've helped thousands of people use options to generate income, but the course isn't always for everyone. That's why, we've been able to get such good results with our students. We're selective, so we asked you to be too. We don't want to sell this course to everyone. We want to help the right people succeed because that's how we get the results. So here's what we found over the years. People who succeed in this program have a few things in common. They do have some basic options experience. So if you've bought or sold a call or put before, you're good. If you've never touched an option, take a look at our Options Jumpstarter course. It's a good place to start. Those who succeed also have at least $10,000 available for trading. Not $10,000 total, $10,000 you can actually dedicate to the strategy. It gives you a little bit of room to breathe and the experience of being able to place multiple trades. Your brokerage should have option 3 enabled or level 3 enabled for spreads. Some brokers that might be even level 2. Make sure you can trade bull puts and bear call spreads in your broker. And coachable. You don't try to outsmart the system. You follow the plan because that's where the results come from. So if you're checking those boxes, you're in the right place. You've got what it takes to be successful using the options paycheck. And it's going to be a very valuable investment in your financial future. And, if you're not there, that's okay too. It just means it's not your time yet. I'd rather help 100 people succeed than sell to 1,000 who aren't ready to have them struggle. Our motto is we work with the right people at the right time. And that's why we have such a high success rate. So again, this is before 6:30 p.m. on Monday. Get yourself registered, $9.95, and this will be your chance to create a good income system in 2025. So thanks again. It was good to present this presentation to you. I hope you guys enjoyed it, and hopefully we'll see you in our class in May. Take care, everyone, and good night.